The US dollar has been one of the most powerful and trusted currencies in the world for decades, shaping global trade, investing, and the entire financial system. But what happens if that power starts to weaken? It's a question more economists, investors, and governments are beginning to discuss as debt rises, global tensions increase, and alternative financial systems slowly grow. If the dollar were to lose influence over time, the effects could reach far beyond America, impacting prices, savings, investments, jobs, and the global economy itself. Today we will talk about what happens if the dollar loses its power, so before we get started, make sure to hit that like button. Also subscribe to my channel 10. Most people assume the dollar will always stay strong. For decades, the US dollar has been treated as one of the most powerful currencies in the world. International trade, global banking systems, oil markets, investments, and financial reserves have all heavily relied on the dollar. Because of this, most people assume its dominance is permanent. They rarely question what would happen if the dollar slowly lost influence over time. But currencies are not powerful forever, by default. Economic strength, global trust, debt levels, political stability, and international confidence all affect how currencies are viewed. And if the dollar ever weakens significantly, the effects would ripple through nearly every part of the global economy. 9. A currency's power comes from trust. The real strength of a currency is not the paper itself. It is trust. People accept money because they believe it will hold value tomorrow. Governments, businesses, investors, and countries all participate in this system based on confidence. The dollar became globally dominant partly because the United States built strong economic, military, and financial influence over decades. But if trust weakens due to excessive debt, inflation, instability, or global shifts, demand for the currency can slowly decline. Currency power is psychological as much as economic. 8. Imports would become more expensive. One of the first major effects of a weaker dollar would likely be rising costs for imported goods. The United States imports enormous amounts of products, materials, electronics, and consumer goods from other countries. If the dollar weakens, it takes more dollars to buy the same foreign products. This increases prices domestically. Everyday consumers may notice more expensive technology, vehicles, energy, food products, and household items. Inflationary pressure could increase significantly because imports become costlier across the economy. 7. Inflation could accelerate rapidly. A weaker dollar often creates stronger inflation pressure because purchasing power declines internationally. If foreign goods become more expensive and confidence weakens, prices may rise across multiple industries. Governments and central banks might attempt to manage this through interest rates or policy adjustments. But inflation can become difficult to control once expectations shift psychologically. People begin spending faster because they fear money losing value. Businesses raise prices defensively. Wage demands increase. Inflation becomes partly driven by behavior itself. 6. Global trade systems could shift. Right now, much of global trade is conducted in dollars. Countries hold dollar reserves because the currency has historically been stable and widely trusted. But if confidence weakens, more countries may begin trading in alternative currencies or developing separate financial systems. This process is already slowly being discussed in some parts of the world. A major reduction in dollar dominance would not happen overnight, but gradual diversification away from the dollar could reduce American financial influence globally over time. 5. Debt would become a bigger problem. The United States carries enormous amounts of national debt. As long as global confidence in the dollar remains strong, investors continue buying U.S. debt relatively comfortably. But if confidence weakens significantly, borrowing costs could rise. Higher interest rates on debt create pressure across the economy because governments, businesses, and consumers all face more expensive borrowing conditions. This could slow economic growth while increasing financial stress simultaneously. 4. Asset owners might benefit more than cash holders. During periods of currency weakness and inflation, people holding large amounts of cash often lose purchasing power. Meanwhile, owners of real assets like real estate, businesses, commodities, or investments may protect wealth more effectively, because asset values often rise alongside inflation over time. This creates another wealth divide. People relying only on cash savings may feel poorer, while asset owners maintain or even increase relative wealth. Wealthy individuals often prepare for currency weakness by diversifying into tangible and productive assets. 3. The global financial system would become more unstable. Because the dollar is deeply connected to global finance, major weakening would not only affect America, it would affect the world. International markets, banking systems, trade agreements, and investments are all heavily interconnected with dollar stability. Sudden loss of confidence could create volatility across markets globally. Countries dependent on dollar reserves or dollar-based trade systems would also face pressure. Financial uncertainty tends to spread quickly because modern economies are highly interconnected. 2. Ordinary people would feel the effects slowly before suddenly. One important reality is that major economic changes rarely feel dramatic at first. Most people would notice gradual increases in living costs, weaker purchasing power, higher borrowing costs, and financial instability long before they fully understand the bigger system changing underneath. Economic transitions usually happen slowly, and then appear sudden later in hindsight. By the time average people recognize the scale of change, financial systems and wealth positions may already have shifted significantly. 1. The real lesson: wealth depends more on assets than currency alone. The deeper lesson is not necessarily that the dollar will collapse tomorrow. The real point is understanding that currencies themselves are systems built on trust, economics, and global positioning, not permanent guarantees. Wealthy individuals often focus less on holding large amounts of cash and more on owning productive assets that can survive different economic conditions. Businesses, real estate, investments, commodities, skills, and ownership structures tend to matter more long-term than dependence on any single currency remaining dominant forever. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.